Hello, everyone. Today on the Final Bar, it's Wednesday, February 15th. We have Greg Harmon of Dragonfly Capital joining us from Cleveland, Ohio. We'll talk about this market continuing to show some resilience, right? The S&P finishing near the highs of the day. Nice follow through on names like Shopify and others. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is really optimized to help us understand the markets by focusing on market dynamics. I was taught early in my career that by analyzing a chart of the S&P 500, you can basically get inside the heads of all the other investors, understand when they're excited, when they're desperate, when they're panicked, when they're euphoric, when they're despondent. All of those things tend to be reflected in the prices of assets. By analyzing those prices, we can gather information about what is most likely to come next based on our understanding of market history and market psychology. Looking at the markets today, I'm struck by how the S&P finishing near the highs of the day, right? In general, breaking above 4,100, pretty key. Following through and holding that 4,100 level, I think has been a pretty important data point. Day like today and through the course of this week, we're showing that that's the case, right? We continue to see buyers pushing price off of that 4,100 level. We'll look at the S&P in a little more detail, as well as some earnings names here in our market recap. Let's get to our dashboard and see what happened to the major averages today. The S&P finishing up about 1/3%, a little bit less, around 41.48 going into the close. And again, what's striking to me, even though we just barely got above yesterday's close, we'd been down around 41.10 and then pushed higher through the course of the day, finishing strong in the last hour. The NASDAQ composite up about 1%. That's doing better than the S&P, of course. Mid caps and small caps all up as well. The VIX now back below 19, almost down to 18. So what had been interesting here over the last week or so is you saw volatility creep up a little bit. We saw the VIX get above 20. Now, all of a sudden, the VIX back below 20, back below 19, and getting lower and lower. One of the things we've really not seen off of the lows in October is sort of that slow and steady accumulation phase, right? That sort of longer uptrend on lower volatility that often indicates that investors are scaling in and adding to positions and just sort of following things higher. We've been rallying on a little bit of higher volatility than average, I would say, in general. But a day like today, we're continuing to push lower on the VIX, which might be an important chart to watch. If you're nervous about these markets, if you're waiting for some sort of bearish move, look for a spike in the VIX, and that would most likely align with some sort of pullback phase. Interest rates all higher today for the most part. We're looking 5, 10, and long bond yields all up a bit. The 10-year yield up about 381. Long bond yields around 385. The dollar index moving up as well. I was interviewed earlier today and was asked about the dollar because I'd made a comment to that reporter months ago calling the dollar the wrecking ball for risk assets. So we talked a little bit about the weakness in the dollar recently and what a different environment that is and how that's allowed risk assets like equities and others to perform well, arguably cryptocurrencies, giving them space to move higher because that stronger dollar was alleviated. Question mark now is what's going to happen next. My guest today, Greg Harmon, we have a chart of the dollar we can look at together. So we'll see what sort of conclusions we can draw. Had a great conversation yesterday with Ms. Schneider of Market Gaze. We talked a lot about the commodity space and about inflation. Today, a lot of red on the charts of commodities. We're looking at 8 commodity ETFs here on our dashboard. The DBC is a broad commodity ETF down about 1%. Same can be said for gold and silver. Oil prices, natural gas prices, all moving back to the downside. As you could probably assume, and you'd be correct, energy was the weakest sector today. We'll look at sectors here in a minute. All green on the top 10 cryptos that we follow. These are some of the most liquid coins that we track in our databases. Bitcoin up about 8.5% today, back above 24,000. This is a level we've not seen in quite some time. Ether nearing 1,700. That's up about almost 7% from yesterday. So that crypto winter, is this the spring and getting into a summer phase? Again, I don't know if I can declare that, but I would tell you that A bullish phase means we go up. A bearish phase is when we don't go up. And I'm seeing a lot of green when I'm looking at Bitcoin and Ether over time here. Let's look at a chart of the S&P 500, just check in on where we're at relative to where we've been. We've talked about this 4,100 level quite some time. I mentioned a recent comments from Larry McMillan, who's a pioneer in options investing and technical analysis, talking about that 4,100 level, the importance of the resistance in November and December. That's the blue shaded area that you see here, kind of ranges from 4,000 to 4,100. Breaking above that level at the beginning of this month, I think was pretty meaningful. Holding that level on a pullback is also pretty important. So very simply, a line in the sand I've been keeping an eye on is 4,100. Can we remain above that level? And a day like today says we can. As long as we remain above 4,100, how negative do you want to be? Because we're not making a new swing low. We start getting below there, we get back into this area of support, then I think you want to clearly define where you might be assessing risk, looking at things like the 200-day moving average, recent swing lows to evaluate it. But for now, market's still making higher highs and higher lows. Well, let's check in. I tell you what, on Bitcoin here really quick. We haven't looked at the chart of Bitcoin in a little while, so I want to bring this back up. This is today's bar. You can see quite a move to the upside. Cryptocurrency is obviously a pretty volatile space, but we've actually seen a relatively low volatility Bitcoin environment for quite some time. We haven't seen an acceleration in either direction really since early mid-January, which is when we rallied off of that sort of 16, 17,000 range and really pushed to the upside, getting above 20,000. We really haven't looked back from there. Look at this level of support, which it was resistance really and became support. This was the peak from early November, around 22,000. You can see that we broke above that level after 20,000, after the 200-day moving average. We continue to push higher. This is when the RSI became overbought, quickly became extremely overbought, which means above a value of 80. We stalled out a couple weeks later and pulled back right back to that same level of support. And now resistance has become support, and we've now bounced off of that level. So, looking at a chart like this, what's very straightforward about it, I would say from a technical perspective, is that you have a clear line. As long as we remain above that February swing low, as long as we remain above this red dashed line, this is a pretty decent trend, continuing to make higher lows. If we would break that, if and when that would be violated, then that tells you, all right, we're no longer making higher lows. Maybe this is a change of character or something different. But I'm encouraged by the rally we've seen in cryptocurrencies. And what's most encouraging is not a breakout, but a pullback and then a continuation, right? That shows you that it's not just an initial influx of demand, but sort of a more sustained advance, more likely, which could be compelling. Looking at the sectors here, we have consumer discretionary and communication services 1 and 2. Neither up a ton, right? To be honest with you, even though the benchmark was up, the S&P up about 0.3%, we'll call it. No sectors up a ton, right? XLY was up about 1.2%. Energy and healthcare, the only two sectors in the red. As I was scanning for individual stocks, for my market misbehavior premium members earlier today, we focused on a couple sectors in particular, consumer discretionary with a lot of compelling charts, something like Aptiv comes to mind. This is one of the auto parts makers, but if you look at Aptiv, a lot of the auto parts stores, retailers, and so forth, all having these nice rotations from a distribution phase where you're making new lows to a consolidation phase where you either have a basing pattern or an inverted head and shoulders, which I would argue this looks like, and then a resolution of that pattern and breaking out to the upside. And that's what's most impressive is seeing these breakouts to the upside and some potential follow through. Also in the financial sector, and I was struck as I was going through names earlier today, charts like Morgan Stanley, like JP Morgan. These are all names that came up in my new 3-month highs list as I'm using the scanning engine, just for looking for stocks on the move. It was about 4-to-1 new highs over new lows in a large mid-cap universe that I scan, all U.S. listed stocks. And I was struck in the financial sector. It's not just the insurance companies. Now, granted, things like Prudential and others have been, that's not the right Prudential, PFG, I think I was looking at. Many of the insurance companies have been in nice runs for quite some time. But if you look, it's sort of the other parts of the financial sector, things like JP Morgan and Morgan Stanley, PGR. That was the one I was looking at. Progressive, right? One of the more sustained uptrends. Those have been the case. And certainly some of the insurance groups have looked consistently strong. But elsewhere within the financial sector, I was pretty struck as well. Finally, we'll finish off here just with our market recap, talking about technology. And I was asked in an interview earlier this week, about what to make about mega cap technology. And my comments on something like Microsoft or like Apple or like NVIDIA, my first comment is they're going up. And that's not a judgment call. That's not an opinion. That's just recognizing the strength and the trend. As a trend follower, my number one goal is to define the trend, right? Identify trends, figure out what's working, figure out what's not working. And then later in the process is focusing on leaning into what's working and leaning away from what's not working. And what strikes me on the chart of NVIDIA or Apple or Microsoft, those three names in particular, which are technology members of what I call the phenomena stocks, those 8 sort of mega cap tech consumer communications names, making new swing highs after making higher lows. As long as that continues, how bearish, how negative do you want to be? How skeptical do you want to be about a market where the leadership names, the names with the biggest weights, are managing to go higher? Let's take a quick commercial break. We'll be back with today's guest, Greg Harmon of Dragonfly Capital. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. As a reminder, a couple announcements before we bring on today's guest, Greg Harmon. First off, we welcome your questions. We really enjoy doing our mailbag segments. We'll do another one at the end of this week on Friday's show. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to answer your question live on the air on Friday's show. Let's check in on the upcoming schedule. I'm excited to talk with Greg Harmon of Dragonfly Capital. We have had him on the Final Bar, but it's been a while, so I'm excited to hear where he's at, looking at some of the major markets. Tomorrow on Thursday, the 16th, we have Sean McLaughlin, who's the chief options strategist at All Star Charts. Next week on Tuesday, February 21st, Danielle Shea, options strategist at Simpler Trading. On Wednesday, February 22nd, Dave Landry of DaveLandry.com. Also, I wanted to let you know my next upcoming free webcast with Market Misbehavior will be next Tuesday, February 21st. We'll be doing an free event called 5 Favorite Breadth Indicators. I'll be walking through the 5 breadth indicators that I use every day. I will tell you how they're constructed, talk through how we can use them, apply them to some historical trends, and then focus on what they're telling us now about the market environment. If you're familiar with breadth, if you're looking to upgrade your analysis of market breadth indications in terms of measuring what I call participation, you want to check out that event. Again, go to marketmisbehavior.com/breadth to sign up for that free event next Tuesday, the 21st. I want to welcome on today's guest, Greg Harmon. Greg's the president of Dragonfly Capital, also a professor at Case Western Reserve University in Cleveland, Ohio. Greg, Happy New Year. Welcome back to the show.
Hey, thanks for having me back, Dave.
It's good to see you. And I know you also, I should have mentioned, you host, you're one of the frequent hosts of your Daily Five. And thank you so much for providing a steady stream of good ideas for our viewers. I want to bring up your charts because as we were looking in the market recap about at some of the major indexes and thinking about asset allocation, your 3 charts, I think, tell a brilliant story about how to think of this market and on different timeframes, which is important. Your first chart's the weekly chart of the S&P 500. Can you talk us through this one?
Yeah, so the weekly chart of the S&P 500, you can see the bottom there at the COVID low in March, and we've got the high at the end of 2021. Since 2022 started happening, obviously we rolled over and we've had the downturn, and we're through that through the first half of the year, and then the hope that we had going into August that it would continue to bounce back up, but no, we fell back further. And fell back to cross just below the 200-week moving average. And that 200-week moving average happens to be right at the 50% retracement of that full move from the post-pandemic move higher. And what I see here is a story that says that we've really had a positive environment since that time. We had to move up into November, October, where we had a move higher, a pullback to a higher low than at the end of December. And now, a couple of weeks ago, pushed up to a higher high. So higher high, higher low. As I heard Dave say earlier, that's when I learned that higher highs and higher lows were uptrends. And that's when you buy, right? But there's more to it than that, too, because we're starting to get to see higher levels in the RSI. For me, an RSI moving above 60 is going to be something that's going to confirm that it's in a strong bull zone. And the chart that I have here is from yesterday. We're about 10 points higher in the S&P today. So we'll probably print up at about 57, 57 and a half, something like that in the RSI. Little bit below the chart then, the MACD has crossed into positive territory. It hasn't been in positive territory since, on the way up at least, since the start of 2021. And that's another bullish indicator for me. But one of the things that I think is really interesting and gets me to think about this narrative that's been in the market about whether we're going to have a recession or not, and is that reflected in stock prices, is the accumulation distribution at the bottom. And you can see the strong accumulation from, it's prior to 2019, but all through 2019 and up until November of 2021. And what we haven't seen is this distribution. It hasn't really happened. We've just stopped buying. We haven't really distributed. So I think that leads to more of the thinking that the market, at least right now, is not thinking about a recession. The market is thinking about reversing back higher at some point very soon, if not already.
Yeah, it's such an interesting walk through what's happened over the last couple of years, Greg. And you've certainly picked up on the arguably euphoria, but certainly a lot of optimism coming off of the lows in October with a lot of individual names. The weekly chart of the S&P sort of shows that rotation. When you're looking at a chart like this, what are the levels above where we're at? If we are in an uptrend and the RSI continues to go higher and we continue to move to the upside, arguably at some point this market, I think, starts to feel rich to certain people. What sort of upside objectives would you keep in mind if we do continue to go higher here?
Yeah, I mean, there's got to be some pressure points that happen along the way, and the first one to get through would be at around 4,300, and then at about 45.25, somewhere in that area, and then the all-time high. And you could arguably state that if we start to get to the point where we're at any one of those levels, and the RSI is risen to being over 70, or the MACD is back up above 100, where it was at the height of 2021, that it might be time to at least put hedges on, or to tighten up your stop losses, or maybe take some profits as well.
One of the big changes, Greg, in your second chart is this rotation in the dollar, right? And we're looking at your weekly dollar chart here, strung through much of 2022, but the fourth quarter, real change. And now we've continued to see some choppiness in the dollar here. What is your perspective on the dollar, where we've been and where we may be headed next?
Yeah, so I see the dollar long term has been moving in in ranges that have lasted about 7 years. We had one from 2015 to 2022, the middle of that time frame, where we had a narrower range to start with, but then a broader range between 88 and almost 104. It was June last year that we broke out of that range and rocketed up to that top there. And during that time frame is when we've started to see the fear starting to come into the stock market, and we saw more collapse. But you can look back and see that all through 2021, as it started to rise in the back half of 2021, it coincides and correlates with the stock market dropping. So the dollar, I think, has been the driver of this whole thing so far. And the driver, it makes sense to be the driver because it's interest rates that are driving the dollar, and inflation that's driving the dollar, and the perception that the Fed is going to continue to raise interest rates. And that whole cycle started in the US ahead of Europe, ahead of Japan, ahead of the UK, so that it looked as though our rates were going to be higher relatively to those countries, and that impacts the dollar and makes it look much stronger, leading to our sell-offs here. But what we've seen now since the October timeframe, the fall off in the dollar, and then dropping back down into that prior range, says, okay, well, maybe we had just a euphoric breakout that took place that's now been selling off. The question is, now that we've dipped back down into the range and kind of held a little bit, it's now back up at the top of the range again. And the question is, does it hold at the top of the range and reverse back down lower, as if it's like a retest of the range and then falls back down? And if that continues, we should see the stock market continue to rise. The downside to that is if it breaks back through to the upside and starts racing above 106, 107, and then you could start to see a change of character in the S&P as well.
Yeah, it's so interesting how these have lined up and how quickly things change. But I love this longer term look. You really see how overextended the dollar was in 2022 relative to the historical trends. It's so funny. I think we often think about, is something going up or down, and we forget about that third option, which is sideways. Arguably, it's been a sideways dollar for quite some time leading into the last 12 months or so. Yeah, your last chart really gets into the interest rate environment. We're looking at bond prices here. This is $USB, and this is a monthly chart. So going back to the early 1990s. Can you talk us through this one?
Yeah, so this chart shows you, what people have been talking about around the bond narrative, that there's been a bull market in bonds for over 30 years, and that many believe that that's just going to continue and that we'll fall back to that. But I think that there's some evidence in this chart, at least, of the potential of a secular change in the nature of bonds, and a change to the downside. And I don't know how long that trend could last, but it's certainly been a much more persistent trend than what we've seen since most people that have been investing have been investing. So we had in 2018 kind of a false breakdown out of this channel. What one of my friends, JC, says is an oops, and then bounces back up into the channel again and came back down and held for a while. But since the start of 2022, we've really also had the real change in character of bonds, and not just that false breakdown, but a continuation lower, a drop below the 200-month moving average that doesn't even, from the data that we can collect here, it's never been below the 200-month moving average. A slight bounce up at the end of the year when we saw the drop to the October low, and now starting to reverse back lower again today. This to me says we're in this environment where we've got stocks that really want to look for an excuse to rip higher. The dollar potentially allowing that to happen if it continues to fall back, and with inflation taming cycles in Europe and Asia still running hot. Seems there's a good chance that that's the case. And now as well, as you look at the exchange between bond assets and stock assets, the interchange between where you might invest, that the alternative is going to look a lot better for stocks than it is for bonds if this downtrend continues. So just more evidence that the potential for the stock market to do better than everyone expects is out there.
Yeah, one of those, we looked yesterday on the show at the just a stock to bond ratio, the SPY versus the TLT. And with some pullbacks overall, it's been just this long stretch where stocks have done better, even with the rally in bonds at times on the chart. When you think about how bond prices have come down, this is obviously coinciding with rates going much higher. And value-oriented parts of the marketplaces like financials have been struggling to outperform for quite some time. But all of a sudden, bond prices coming down, rates going up, gives room for that to sort of work. When you're looking forward through the end of the Fed's rate hike cycle and all of that, and just looking at the charts, are you seeing more opportunities in value-oriented parts of the marketplace like industrial financials, or more growthy things like technology that have really emerged so far in 2023? Where are you looking going forward now?
Yeah, at least for the next 6 months or so, I think the places like the industrials do look very good. And there's a scan that I run every night that looks for momentum and looks for price activity, and the industrials have been creeping up on that, but consumer cyclicals have also been creeping up on that too. So those are a couple areas that I've been looking at, and think that they're going to continue. You can't tell me that tech is not going to turn around, because the whole world is driven by tech now, and I think we need to as a classification, split it out into a whole lot of different things instead. Or as one of the classes I teach is fintech, and we're starting to stop calling it fintech and starting to just call it finance, and finance has technology in it. So I think all the other sectors are like that too.
I think that's such a brilliant idea. And it reminds me, within the technology sector, there's a lot of diverse businesses. You can't really think of it as one thing anymore. It's a really good point. Greg, listen, thanks for bringing some charts with you, particularly the longer term charts. Really thought-provoking. We appreciate it. Be well. Say hi to Northeast Ohio for us, and we'll talk to you again soon, all right?
All right. Thanks, Dave.
That's Greg Harmon. Greg's the president of Dragonfly Capital. Is also a professor at Case Western Reserve University. So shout out to his students at Case. Where my brother got his MBA. Really cool discussion of the charts. And I love if you think about the charts, and I ask all of my guests just to bring 2 or 3 charts that they'd like to talk about. What strikes me when I'm looking at the charts that Greg sent earlier today, they're really long term. And what I love about the discussion, what I love about the charts, is that it makes you think about how this period, how this moment relates to other periods. I would argue that's one of the big goals as an investor, particularly a long-term investor, is think about historical relationships. How does now relate to other periods, and use your knowledge of market history to get a sense of where things may be headed. Great thought-provoking charts there from Greg Harmon at Dragonfly Capital. We need to wrap the show, folks. Go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Chart number 1, I love Greg's comments about technology, particularly the diverse businesses, maybe breaking technology into some other sectors. Not a bad idea at all. And I'm struck when I'm looking for stocks making new 3-month highs earlier today, names like Shopify and others kind of bubbling up here. Where you're looking at charts like this, again, think what you want about value over growth, think what you want about the dollar or interest rates. In my opinion, the most important thing is to look at the chart. And when I'm seeing a chart like this one with a really clearly defined resistance level, we'll call it a neckline, and the inverted head and shoulders, the low surrounded by higher lows, a clear violation to the upside and continuing to follow through, that's a strong chart. So the why, in terms of why Shopify is doing so well off of the lows, will probably become really obvious down the road. The reality is the chart is going up. And as long as that continues, I'm inclined to assume that trend will probably persist. Chart number 2 is the dollar. I loved Greg Harmon's long-term chart of the dollar. That was actually really interesting to think. I so focus on the 1-year and 2-year timeframes with my daily charting process, but thinking about the bigger picture, the longer term is really, really meaningful. Just look at how this trend has rotated from a clear uptrend going into the 4th quarter of last year to a clear downtrend. And even though we've rallied a little bit, I would argue on the longer term time frame, the trend still remains lower. The dollar index is actually testing its 50-day moving average from below. And oftentimes in uptrends, you will find a chart pull back to an ascending 50-day moving average. You saw that through much of 2022 for the dollar index. Now in a downtrend, we're testing a descending 50-day moving average from below. Can it break through? If and when that happens, then I think you can start thinking about a different environment for the dollar. And again, rising dollar, we've talked about it being sort of the wrecking ball for risk assets. Unlikely that our averages would rally significantly. Also watch the RSI and see if it's able to remain below 60. Finally, stocks actually breaking down. The average stock is doing pretty well here. The breadth conditions are pretty strong, generally speaking, but there are areas of the market that are showing some weakness. E&P stocks, which is a group within the energy sector called exploration and production. Charts like DVN and others like it are probably showing the most weakness, besides the ones that have been in pretty consistent downtrends. These are the ones that had been leadership really in the first half of last year, more consolidating in the second half of last year, now starting to break down. Bullish charts tend to find support at key moving averages, particularly the 200-day moving average. Just like Apple and Microsoft, so impressive that they're breaking above their 200-day. I am not impressed by charts like DVN and others in the E&P space breaking down through their own 200-day moving averages. Folks, that's a wrap for the show. I want to thank Greg Harmon of Dragonfly Capital joining us from the Cleveland area. Great long-term charts and good perspective. All of our previous interviews and discussions, some really valuable thoughts on the markets here can be found for free at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a good night. See you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.